production, you need to have a purchase of raw material, you need to hire people, you need to pay the electricity and the water bills, and you need to go for several other expenses on a day-to-day basis. So you require cash for that. You need to pay the salaries, you need to pay the wages, you need to pay the interest. So you need to have cash for that. So now the setting of the factory is a lump sum requirement, and it has, after it has been done, the management of cash becomes a daily routine. It becomes a daily affair where we'll have to manage the daily requirement of cash. So that is why we have today we're talking about this appropriate management of cash, and how is it being done, and what are the strategies to manage this cash. This is what we're going to be discussed today. Now, when we talk about cash management, I'm basically referring to a balance between whether to have huge amount of cash in hand, or whether to have less amount of cash. Now, see, if a manager is, risk taking by nature, he would like to have less amount of cash, and he is confident that he can manage within less amount of cash. But if a manager is conservative in his approach, he would like to operate with a higher level of cash. Now, there has to be balance between the level of cash which is highest or which is lowest. We have to strike the right chord, and we have to go for the optimum level of cash balance. Now, what is the problem in holding high amount of cash? As we all know, cash is the most idle of resources. It doesn't generate any return as such. You use cash, then only you can generate some return. But cash as it is, if it is kept idle, it doesn't generate any return. So if you have huge amount of cash, you are just foregoing the return that you could have generated by use of cash, by using it somewhere else. So you cannot have huge amount of cash. So because huge amount of cash will mean that your liquidity is taken care of. Like, you can pay the bills as and when they arise. Your liquidity is very high, but at the same time your profitability has gone down drastically, because you're holding cash which could have been alternatively used somewhere else, could have generated some return, but because you're holding too much of cash, you are foregoing that profitability part. On the other hand, if you have less amount of cash, so your liquidity will be compromised. So there might be scenarios where probably you need to pay the bill and you don't have enough cash. So liquidity will be compromised, but at the same time, the cash which has been used elsewhere is giving you good rate of return. So ensuring that your profitability is high. So cash management is all about balancing between these two aspects of how much of cash should I hold. Should I hold it at a highest level, or should I hold it at a lowest level? So when I'm talking about cash management, I'm basically talking about optimizing these benefits and costs associated. Now, just now we talked about the benefit. If I'm holding cash, my liquidity is high. But if I am holding it too much, then there is cost, that is in terms of loss of profitability. So I need to balance. The cash management talks about balancing between this cost and profitability. Now, and what should be the objective? Why I'm doing it? I'm doing it because I'm going to balance these things, and I should be holding sufficiently enough cash, so that which is just required. I am going to hold the amount of cash which is just right for my business, so that I get the maximum benefit out of it, and so that my cost is minimum. So I decide on the optimum level of holding of cash. These are the objectives with which we go for cash management. Now, when we talk about cash, by cash we actually mean the real currency terms. It also means the near cash items. For example, the securities which can quickly be converted into cash without much loss. It also means the marketable securities, which are short-term interest earning assets. So we'll talk about the marketable securities in a separate class altogether. So when I'm talking about cash, by the way, we mean all these things. Now, just now we talked about these objectives of cash management. So when I'm talking about cash management, the objectives are twofold. That is, as and when you have some kind of a payment coming up, so you can take care of your disbursement needs. That means when a creditor or any supplier or any party come, or the employees, whenever the time comes for to release their payment, the company should have enough money to release the payment, because you see, you use cash to pay the bills or pay the salaries. So you should be able to meet the disbursement needs, or you should be up to date with your payment schedule. So if your payment schedule says that the salary is to be released on first, it will be released on first. But if you don't have enough cash to release the salaries on first, then obviously you have a poor cash management system. And at the same time, as I said, you should have minimum funds committed to the cash balances. So these are two paradoxical situations. On the one hand, I need to have enough cash so that I can, meet, I can be up to date, my payment schedule is not disturbed. And on the other hand, I'm saying that yes, the commitment of funds has to be minimized. You cannot have enough cash. So you have to balance between these two things. This is the reason why we're discussing the concept of cash management today. Now, having talked about the various aspects of cash management, there are various facets of cash management that you should be aware of. The first thing is, when I'm talking about cash management, I have to plan for my cash. That is how much of cash it will be required. For example, if I'm right now in April, I need to be aware about what will be the cash requirement for the rest of the year. For example, how much it will be required in May, how much it will be required in June. So you should plan in advance what should be the cash requirement in the coming months. Now, how do you do that? You can do that through various techniques. We'll be discussing one such technique here. Like, for example, if you know that you are going to receive, let us say, 5 lakh rupees in May through sales collection, and you know that you have a payment schedule, and your payment schedule says, your collection schedule says that you will be receiving 5 lakh, and your payment schedule says that you have to pay out 7 lakhs. So which means that in the month of May, you will fall short of cash by 2 lakh rupees. So now you can plan what I'm going to do about that 2 lakh rupees, or vice versa. Suppose your requirement is 5 lakh, and you know that you are going to receive 7 lakh rupees. So in that case, you will have a surplus of 2 lakh. So now you can take decision what to do regarding the plus 2 lakh or the minus 2 lakh. Which means if you have a requirement of 2 lakh, how are you going to arrange it? That decision you can make. Or if you have a surplus cash of 2 lakh, what are you going to do with it? Whether you are going to keep it idle or whether it can be used elsewhere, those things can be done only when you know that this is going to be my cash position in the next month, or 2 months from now, or 3 months from now. So, and how do I know it? I can do it only through planning. So this is what we'll be talking about in cash planning. So planning is a very important aspect of the cash management system. Next is how do you manage your cash flows? When I'm talking about cash flows, I mean cash inflows and cash outflows. Now, what are the cash inflows? Like, for example, one very good example of cash inflow is collection of sales. Okay, and what example of a cash outflow is payment of salaries. There are several examples of cash outflow: payment for raw material, payment of salaries, payment of interest. So various kinds of cash outflows. Now, see, we're talking about cash management simply because my cash inflows and cash outflows, they are not matching. That means today, suppose, let us assume that today is 10th of April, and today, if I have a requirement of 3 lakh of payment of 3 lakh, and I know that at the end of the day I'm going to receive a 3 lakh rupee cash, then I need not manage, I need not plan for my cash. But because I know that today my payment is 3 lakh and I don't have any receipt today, so I need to arrange. So this is I'm talking about cash management simply because my inflows and outflows are not matched. So how do you manage? So what are the ways of managing? What are the strategies to manage? This is something that we'll be discussing in managing cash outflows. So what do we do? What do we discuss in this management of cash flows? When I'm talking about inflows, probably I try to speed up the cash inflows. And when I'm trying to talk about the management of cash outflows, I'm probably trying to delay the cash outflow as far as possible within the legal limits. So that is the meaning of cash inflows. So that's the second facet of your cash management. And when we talk about the third aspect, that is how much of cash. When I'm talking about, just now we said that we have to strike a balance between not too much of cash, not too little of cash. So then I need to have an optimum level of cash, and this optimum level differs from one company to the other company, and it is subjective to the environment in which the company is operating. So I need to be very sure about how much is the right amount of cash I should be having. So that is called the deciding the optimum level of cash. And this is a very, very important aspect, because if this calculation goes wrong, then you will either face one of the two consequences. You will face a risk from liquidity, or you will face the risk from the profitability. I mean, lesser profitability. So this has to be appropriate planning on cash balance. And the last but not the least, when you are having surplus cash, suppose your collections are exceeding your payments, so you are having surplus cash. What are you going to do with your surplus cash? Are you just going to keep it in your balance, in your simply keep it in your hand or keep it in the bank, or are you going to invest it in some other project or invest it in some other company shares, or what are you going to do with your surplus cash? That also is a very important facet of your cash management that we'll be looking at. Now, so this is what we were talking about, the cash flows into and out of the farm. So you have both inflow as well as outflow. Into the farm, inflow; out of the farm, outflow. Now, again, you have cash flows within the farm as well. Now, when I'm talking about cash flows within the farm, so for example, if the marketing department comes up with a let us say with a big campaign to increase the, I mean, to achieve a sales, to increase the volume of sales, then they require huge amount of expenditure to go through the campaign. So then obviously you have to transfer some amount of cash. So that is called the flow within the farm. So likewise, there could be several examples of cash flow within the farm. And then you have the balances. So when I'm talking about cash management, it is not just managing the cash inflows and outflows, it is also managing the cash flow within the fund. It is also looking at the investment of surplus cash. It is also looking at the balance that you are going to keep at any point of time. And if you look at the this simple model of how this cash management works, this is how probably it will look like. The you have here, like you have here the business operations, and these business operations actually give rise to your either cash collections or cash payments. And obviously that when I'm using information and control, we talk about something called MIS, which we'll be doing in the subsequent part of the class. So you have collections, you have payments. Your collection exceeds your payment, you have surplus. And when your collections fall short of your payments, you have deficit. Okay. Now, if you have a deficit, you borrow. If you have a surplus, you invest. So the very essence of cash management is to be able to predict this, so that you can decide on whether I'm going to borrow or whether I'm going to invest. So at any point of time in the future, whether you are going to experience a deficit or whether you are going to experience a surplus of cash, is what we are doing to we are engaging in all this activity to be able to predict these two things. Okay. Now, coming to why companies need cash. We started the class with the why the cash is needed, with all sorts of activities you need the cash. Now, the motives of holding cash is manifold. I mean, the companies hold cash. Simply, nobody is comfortable with not having cash. Like we as individuals, if we are asked to operate without any cash, will be uncomfortable. All of us know that. Similarly, when an organization is asked to do manage with little bit of cash or no cash, they also become very uncomfortable. So we need to have certain amount of cash in hand. And why do we need that? It's just not just psychology. There are other requirements of cash. For example, number one is a transaction motive. So when I'm talking about transaction motive, these are pure business transactions, are the expenditures that you have to do primarily for the purpose of business. Now that is settle customers' bills, pay the salaries, pay the wages to workers, pay your taxes. So these are the things that you have to do. If you are in a business, you have to do these things. So this is the transaction motive. Now then you have something called a precautionary motive. Now when I'm talking about a precautionary motive, so there is a chance, for example, there is a chance that non-routine needs, for example, let us say that it could be shortage of something, like when your future this thing is uncertain. So for example, let us say on a particular day you have been selling 100 units of your product. Now suddenly there is a spurge in the demand and you experience a demand of, let us say, 150 units per day. So to meet that 150 units of demand, product, what will you do? You will step up your production. You need to step up your production. So in order to step up your production, what you have to do? You need to purchase more material. You need to process it faster. You need to produce more goods, and then sell the additional 50 units to the customers. Now, if you don't have cash, how do you think you will manage this? Only if you have cash, you can immediately step up your production. So the whole issue is you are not sure. Like your experience says that you have been selling 100 units per day, but that could be a scenario when there will be certain spurts in the demand, and then so for that purpose also we need to have some cash. Like in order to be able to meet the unexpected demand, or for that matter, suppose let us say there is a shortage of something. Okay, so when we are talking about this kind of uncertainty, dealing with some kind of uncertainty, then we talk about this precautionary holding cash for the, we need pure for transaction motive to pay bills and all that. Then over and above that, we also hold some amount of cash for this precaution, as precaution. Then the last category of cash that we hold again is for speculative motive. For example, that is to earn short-term profit. For example, let us say I am the procurement manager of a farm, and I come to know that the raw material price is going to be revised in next fortnight. Okay, the later part of April, the price of raw material will be revised, and there is a general expectation that the raw material price will go up by 20% in the last fortnight of April. I am currently sitting in the first fortnight of April. So, and I am the procurement manager. Though my requirement is not there, suppose I am procuring goods or raw material as per my requirement. Though my requirement is not there, now what I'll try to do is try to take advantage of the possibility that there might be a price hike of the raw material. So I will try to procure as much as possible in this particular fortnight. So this is why I am doing it. I am doing it with a motive of making profit, because if I wait till there is no news regarding it, I am expecting that there will be a price hike, and so I am piling up my raw material with this motive. So this will classify as a speculative motive, because this here the motive is profit. So profit motive. Or for that matter, another example with the finished good. Suppose you come to know that due to a certain change in the regulation, the demand for a particular product is going to be probably there is a revision in the product. the demand of a particular product. So you will procure more material and then go on producing more with the hope of being able to sell. So that is called the speculative motive with which you are holding cash. You are not sure whether that will happen or not, but you come across a news, your expectation says that there will be a profit potential in the future, so you are investing in that. So yeah, that is holding cash for the speculative motive. So obviously it is advisable to hold some cash for speculative motive, but the banks positively discourage this kind of holding of cash. Transaction motive is okay, some kind of a safety cash as for the precaution. So and many banks, they discourage this speculative motive holding of cash. Now, as we talked about this internal cash flow and the inflow and outflow, the external. So now the when we talk about the cash flow, there are several factors that affect the cash flow. There could be several factors which are internal to the company. There are several factors which are beyond the company. Now, what are the factors which are the internal factors? The production related policies, for example, let us say, what will be the production related? You are going to, let us say, stepping up your production, or you are going to say holding up your production for a few days, or you are going to go for, let us say, piling up of the inventories, or you are going to for automation and you will operate with a just in time kind of inventory. So that decides what will be the cash flow. So it is understood that if you are talking about holding up the production for some days at a particular level, minimal level, then requirement of cash inflow will be, cash flow will be minimal. But if you are going to step up your production, you'll have huge amount of cash inflow and outflow. Now, second, the policies on discretionary expenses. Now, what are discretionary expenses? These are not directly concerned with the manufacturing expenses. These are as per your wish, as per your choice. So, I have to cite the examples of discretionary expenses. For example, you talk about R&D expense. You talk about, let us say, replacing a vehicle before the economic life is over. So this kind of policies are discretionary policies. Now, expenses. Now, you engage in discretionary expenses, so that is going to affect your cash flow. Then you have policies on receivable, whether you are going to operate on credit. Yesterday, in the last class only, we talked about the receivable. So what kind of a credit policy you are going to operate, what will be the receivable days. So if you are going to prolong your receivable, you will have more cash requirement. You are going to operate only on cash, your cash flow will be in a different way. So the kind of receivable policy you are deciding, that also decides on have an impact on the cash flow. The various financial policies. Now, the apart from the capital expenditure for the expansion of your plant and factories. Now, your where from you're getting the finances like debt or equity, or from internal sources. So this thing will be also affecting your cash flow. Now, the payment policies, whether what kind of payment schedule you have, whether you have you are going to pay before any demand comes to you. For example, a bill is due on, let us say, 30th of April, whether you are going to pay it well in advance, or whether you are going to pay it on 30th, or whether you are going to pay it on 2-3 days after 30th. That also decides what kind of policies you are pursuing regarding payment, also has an impact on the cash flow. And there are, again, as I said, there are several factors which are beyond the control of the company, like monetary and fiscal factors. Like we talked about monetary and fiscal factors, monetary factors specifically in details in the Unit 1. And the banks try to tighten the money flow in the economy through various various methods. So the overall monetary and the fiscal factors will have a say, because if you are under tight monetary conditions, you will hardly get money for your speculative purposes. So banks will not finance that. so it will have a impact on your cash flow. So there are also industry related factors. For example, what is the norm in the industry, and the whether you are operating in a service industry, whether you are operating in a retail, so that will the industry, what is the norm of your industry, will also have an impact on the cash flow. So now we talk about the forecasting of cash. So now that we have discussed like why company needs to have cash, why uh, what is the purpose of cash management, and we know that the planning and the forecast, I mean the planning for the future is important. We can only plan for the future only if we have certain tools and techniques to forecast. So we talk about forecasting now. The cash planning, as we talked, it's a technique to plan and control the use of cash. So how do we plan and control for the use of cash? We do it through budgeting and forecasting. So probably it is forecasting and budgeting, because on once I forecast, that I'll be able to budget. So the cash forecast are needed to prepare the budget. So we should be having some techniques for forecasting the cash. Then we talk about the preparation of the cash budget. So we'll see shortly how this cash budget is done. Now, when we talk about this cash forecast, these are normally, usually cash forecast is usually prepared for 1 year, but it is many times for the preparation of cash budget, it is broken down to several small periods. Like you can have a weekly cash budget, you can have a weekly forecast, you can have a monthly forecast, you can also have a quarterly forecast or a half yearly forecast. So, but usually when we talk about cash forecast, it is 1 year and broken down to several sub periods. Now the and obviously we're talking about here because I'm talking about 1 year, so it is short term cash forecast. So why is the short term cash forecast very needed? Because it determines the operating cash requirement. It anticipates also the financing needed in the short range, and it also helps us in deciding what we will do with our surplus funds. Okay, so the while we talk about the various forecasting methods, we have the receipt and disbursement method, and we have the adjusted net income method also. So we normally use this receipt and disbursement method, most popularly is used for the preparation of this cash budget. Okay, so the okay, I think this thing, there is a little bit problem with the slide. So I think there is an overlap of this slide of, your receivables. So I'll use my own resources for that. Now, when we talk about this cash forecasting, we talk about this budget, the cash budget. So when I'm talking about a cash budget, basically what I mean is you have, as I told, you talk about this receipts and disbursement. Okay, so in receipts and disbursement, we basically have this. We prepare the cash budget in a way where we talk about the, basically the receipts. And under receipts, you have, for example, receipts from sales, cash sales. Then you have collection from debtors. Then you have loans. You can have, for example, you can have the capital assets, sale of capital assets. You can have many other sundry receipts also. So the you sum up the total of these receipts, so that will give you the cash inflow part. Then you talk about the payments. Under payments, we can discuss about the various cash purchases that we are undertaking. We can talk about the various payments to the creditors, for example, suppliers of your raw material and such. Then you can have the payment to the towards the wages and salaries, the interest that is payable, then the various kinds of capital expenditures, the loan that you have to repay, the taxes, the dividends, all these make up the payment schedule. Now you have a block for your receipts, so you sum up the, so you get all the cash inflows, and then you find out the payment, all the kinds of payments. So you sum up, you get the this all the cash outflows. So the inflow minus outflow will give you the total figure for your whether it is plus or minus. If the inflow minus outflow is a plus, then you are in the surplus. So, and if your inflow minus outflow is a minus, then you talk about the this thing, the deficit. So if you have a surplus, you go for investing the surplus. If you have a deficit, you go for the the borrowing of a short-term loan. Okay, so when we talk about the cash flows, there are various kinds of cash flows. These are independent cash flows, there are dependent cash flows, and there are also various cash flows which keep on growing over a period of time. So when I'm talking about independent cash flows, so there are cash flows which are independent in the sense that they are not dependent on any other activities of the business. For example, lease rentals. For example, rent that you are paying on your premises. Okay, so these kind of these kind of expenses or cash flows are not dependent on the business activities. Whether what kind of a business activity you are having right now does not interfere with the lease rental that you are paying. It is fixed in the beginning of the period. So these are called independent cash flows. Then you also have the dependent cash flows. So when I'm talking about the dependent cash flows, these are all dependent on the business activities. For example, if your sales increased this particular year, so you will have a better sales collection. Okay, so the collection from the cash sales or the collection from your debtors will increase if your sales revenue increases. Or for that matter, suppose you talk about automating your plant. So when you're going for automation of plant, there will be cash outflow. So, so the outflow, these kind of expenditures are called dependent cash flows. Then you have growth, that is the business as whole will grow, and based on that there will be several cash flow items which will be growing. Okay, so yeah, these are called the growing cash flows. Now, when we talk about the methods of forecasting, so you can have a direct method. You can have a direct method of forecasting. So, under this direct method of forecasting, so how can we talk about direct method of forecasting? In a direct method, you just look at what did you do in the last year. So look at that, refer to that particular figure, and then you forecast. So probably add up a little bit of percentage on the last year's figure. So you talk about the direct forecasting. Then you have proportion of another account. For example, what will be your tax as a percentage of your gross profit, or what will be the variable cost or the the contribution as a part of your sales. So the second method is a proportionate method. What kind of a percentage on another figure, on suppose another variable which is called x. You can also have the third method, the direct method, the proportion on another account method. Then you have the compounded growth method, like for example something called a CAGR method. Like how am I going to predict the cash flow? Under this method, what I do is, let us say, I say that this year's cash flow is going to be G percentage above last year's cash flow. So y subscript t minus 1 will be my last year's variable, and this year's variable will be y subscript t. So I'll do what is 1 plus g on that. Okay. So that will be the compounded growth method. Then you have multiple dependencies. Multiple dependencies. So when I'm talking about multiple dependencies, so which means that you have, let us say, a number of variables like x1, x2, x3, x4, all of them affecting one particular variable. So this has a relationship, this has a relationship, this has a relationship, this has a relationship. For example, when I'm talking about, let us say, the collection from sales. Okay, so collection of sales is dependent on, number one, demand in the market. Number two, your credit policy. Number three, the the discount that you're offering, and so on. So that could be several factors which contribute to the collection from your sales. So how do you find out then what will be, how to predict this for the next period? So collection from sales, how am I going to predict? So if I'm going by this multiple dependencies, probably I can run a regression like this: y is equal to b1 x1, b2 x2, b3 x3, b4 x4. Like this, you can run a regression and you can find out this value of y. So this is a complicated procedure. So okay, so next is your simulation approach. We have the simulation approach. Okay, now under simulation approach, what we do is when I'm talking about simulation, I talk about various kinds of scenarios, various kinds of probabilities. Now, for example, if the example is, let us say, you assign some kind of probability. Suppose if event 1 happens, this will be my cash flow. Okay, let us say my cash flow will be 10,000 if scenario 1 happens, and the probability of that is 0.2. If the second event happens, my cash flow will be, let us say, 14,000, and the probability is, let us say, 0.3. If the third scenario happens, my cash flow will be, let us say, 15,000, whose probability is 0.5. Okay, so now I have 3 scenarios, and these are my 3 cash flows. These are the probabilities. So I can do a simulation, and now what I do, I have a average, expected value. I have a standard deviation. So I plot these things. Write down these things on a matrix. So I get the various figures. The event, the month. You have the average figure, you can have the standard deviation figure. So using these, you can go for a lot of decision making while planning for this particular cash. So then we talk about the various so how do I do this average calculation? So here what I can do is, let us say, expected value, the expected value of this particular cash flow. How do I do it? I can do it like, let us say, 10 into 0.2 plus 14 into 0.3 plus 15 into 0.5. Okay. So how does it work out? 10 into 0.2 is 2. 5.2, 7.5. So that works out to 14.7. So I can have my expected cash flow for the next month is probably 14.7 thousand rupees. So and then using these probabilities and all, I can also compute the standard deviation. Okay, the standard deviation of my cash flow. So when I can compute the standard deviation of the cash flows, how do I take this decision? Now I have a table where here I have, let us say, a table where I have the month, I have the average figure, I have the standard deviation figure, and average and standard deviation are all in rupees terms. So the distribution of the month-ending cash balance, we have to assume that the distribution of this month-ending cash balance, this is an assumption that we have to make. So we can be used to determine the upper and lower estimates of the cash surplus or the deficit for a particular month. And how can I do it? Suppose here I have the month figures and corresponding averages, corresponding standard deviations. So now what we can do is, I can estimate whether it is going to be a surplus figure or a deficit figure. And how do we know that? Now we have to make an assumption here that the month-ending cash balance is normal. Now if it is normal, then how do I compute it? That is upper or lower estimates is equal to the average cash balance plus the z times my standard deviation. Well, now we come to the value of z. What is z? The z is the standard normal variable variate that we have studied in the methodology part papers. Standard normal variate. Okay. Now with this kind of information in hand, now the finance manager can make necessary predictions for the particular month. So the last part when we talk about this cash management is then the number one, various issues in this your cash management. Managing the uncertainty in cash flow. Managing uncertainty of cash flow. Then you have something called managing the surplus cash. Then the third issue you have managing the fund transfers. And the last part is how am I going to manage the cash flow inside the organization? So you talk about the MIS part. Okay, so the MIS in cash management. So when I'm talking about this managing the uncertainty, now we all know that everything said, whatever techniques we have used, be it sorry, the regression and all that, there will always be uncertainty in our cash flows. So how do we manage this kind of uncertainty? So one of the methods is scenario analysis is there, simulation is there, all these things are there. But that is the reason now you must be able to, correlate that when we, in the beginning, when we talked about there is a transaction motive of holding cash, there is a precautionary motive of holding cash, and there is a speculative motive of holding cash. Now you can imagine that because there is uncertainty, so what can you do? Yes, you will have the regular requirement of cash that is in hand, plus you will have to have some cash or this extra cash which you can talk about as a safety stock that you can manage for the cash. So you are basically having the some additional amount of cash to deal with the uncertainty. But then how much of additional cash, that is also important. So that probably the many aspects of that, how much of the cash will be dealt with in the next unit. So the all you can do is go for various kinds of scenario analysis and all that, and manage with a little bit of extra cash. Okay. And you need to have also very good relationship with the bank, so that you can avail short-term loans as and when you require. So you should have taken care of your borrowing base. Your borrowing base should be very appropriate, so that you can in a very short notice. Now see, it is one thing to have business dealings with a bank, so that you can as and when avail the cash, but then at the same time the banks will not give you cash just because you have a regular business dealing with them, if you don't satisfy the norms, the various adequacy norms that are required by the bank. So you should first see to it that your borrowing base is appropriately maintained. Now if your borrowing base is maintained and you have a regular transaction with a bank, then you can arrange for the short-term finances, short-term loans on a very short notice. So suppose the additional cash that you're holding in hand is not sufficient to deal with the uncertainty that you think, then you can probably in a very short notice arrange for the short-term loan. So then that is how you can manage the uncertainty in the cash flow through these methods. Then we talk about the management of this surplus cash. Now when you have surplus cash, now you see, for example, we are now in the month of April, and we see that in the month of May, I have a surplus cash of around 4 lakh rupee. My budgeting says that in the month of May, I'll have a surplus cash of 4 lakh rupee. Now, there are so many things I can do with a surplus cash. Number one, I can invest that surplus cash in, and I know that until the next 3 months, I don't require this surplus cash. Let us say in June, July, August, in these 3 months, I don't require this surplus cash. I will require the surplus cash again in this month of September. So what I can do is, let us say, probably invest that surplus cash for 3 months and generate some rate of return on that, or use the surplus cash to probably repay a part of the loan, part of the short-term loan which is outstanding, and so that I save myself of the interest burden. That I can do with surplus cash. So there are several things that I can do with the surplus cash. Either you can invest, you can repay a loan, and every month the surplus cash, whether it can be used to pay the advance taxes, or can it be used to pay the dividends. So there could be several uses, whether it will be invested or it will be used in some other business transaction. That can be seen if you have surplus cash and you know beforehand that this is going to be the surplus cash. That can only be found out through the planning and the budgeting aspect. Now, where can we invest? If we talk about investing, where can we invest? So the surplus cash, there are several avenues. Probably if you don't require it for a long period, you can invest in a long-term asset, or you can keep it in the bank and in the some certificate of deposit, some money market instruments you can invest. These things we'll be talking about in the next class. So where we can invest the surplus cash. But all I'm trying to tell you is there is several uses for the surplus cash, and we can only do that, manage that surplus cash, only if we have advanced knowledge that how much of surplus cash will be there in which period of time. And then we talk about the next important thing, that is the managing the fund transfers. Okay, so probably if you go back 10 years, you did not have this prevalence of this NEFT and RTGS. Now in that period of time, there was a concept called float, and the cash manager was required to play the float. So basically what it meant is when we're talking about managing the cash in the beginning of the session, I told you that when we're talking about outflows and inflows, so I'm basically trying to manage both the outflows as well as the inflows. So when I'm talking about the management of the outflows and the inflows, it is basically I'm trying to speed up my inflows, and I'm basically going to delay or delay as much as possible within the legal limits, as I said, my outflows. Now the whole issue is how can I speed up my collections. Speeding of collections, you have various that we saw in the receivable management. The collection department takes care of that. And when we're talking about payments, now the whole issue, this entire technology has changed the way the cash management is done. Now the system of these electronic remittances that has been introduced by all the banking firms, and all that has been adopted by all the organizations. This has achieved this objective of not dealing with cash and also not dealing with the checks. So we now have a checkless payment system. Okay. And added to this technological advancement, we also have now anywhere banking, which is practiced by many of the banks. This is also helping in terms of your electronic fund transfer. So the concept of float, which was earlier there and was a very important concept, it has been done away with under this regime of the electronic fund transfer. Now, because and coupled with that, you have these changes in the Negotiable Instrument Act of 1881, where the dishonorment of a check is both a civil and a criminal offense. And so the payment mechanisms are now properly ensured, so you have to be very careful regarding this. The check bounce did not used to be a offense a few years back. Now it has become an offense, both civil as well as criminal offense, and it is probably it comes with a harsh punishment also. So the whole issue, you have to be very careful regarding how you are managing your funds. So when you are managing your funds, you can do it. Cash is ruled out of the question, but you can do it through check as well. But you have to be very careful when I'm issuing a check whether there is enough balance in my account or not, or migrate to the NEFT and RTGS routine. So that will manage your fund transfers appropriately. And then we talk about this MIS. So obviously, when we talked about this particular model, we talked about this MIS. So the whole thing is taken care of by the MIS. This is the appropriate system of the MIS. So under MIS now, there is one issue. Now we talked about the cash budget. Now in a cash budget, we in a monthly basis, we talk about a surplus, we talk about a deficit. Suppose our cash budget is prepared on a monthly basis, or vice versa, a quarterly basis. Okay. So when I'm talking about, let us say, a deficit or a surplus, 1 month has passed or 1 quarter has passed. Correct? So I will know whether I will have a, suppose my minimum, the lowest cash budget that I am preparing is a month. Okay. There is a quarterly cash budget, there is a annual cash budget, there is also a monthly. So my minimum denomination of my cash budget is, let us say, month. So at the end of the month only, I will come to know whether there is a surplus or there is a deficit. Correct? And which means that I did not do, let us say, that I had 30 days to take some kind of a corrective action to, if not 30 days, maybe 10 days, maybe 20 days, to take some corrective actions regarding this. So all I'm trying to tell you is, if I'm only dependent on the cash budget for this planning of forecasting and planning of cash, then I will come to know about my cash position at the end of the budgeting period. correct? And if I'm coming to know about the, suppose at the end of the period I'll know that there is a deviation. I was supposed to have, let us say, 10 lakh. Now I am observing that there is a collection of only 7 lakh. So if this is the problem in the collection, the entire cash budget, the surplus will now become deficit. So because in the cash budget you have a receipt section, you have a payment section, then you have either the surplus or the deficit section. Now if here is a shortfall, then there will, and this, if this falls and there the payment remains constant, then I'll have a deficit obviously here. Probably that could result in a deficit. But when will I come to know about it? I will come to know about this surplus or deficit at the end of my budgeting period. Okay, so and probably then it would have created a chain reaction where the corrective action that could have been taken, that time is gone. So instead of waiting for I'm not saying that we'll do away with the cash budget, but what I'm trying to tell you is that the cash budget is there, but if we can have a system where we monitor things daily, and obviously when I'm talking about daily monitoring, it cannot be done on a manual basis. Okay, so if I can know that this is what is happening on a daily basis, then probably I can take corrective action as and when there is a deviation. This requires you to be on always on your toes. Now the point is, can you really monitor the operations on a daily basis? If you monitor the operations on a daily basis in a manual system, then obviously your efficiency at other places is going to go down. So you can only do it through ERP, the computer-based MIS system, the information systems, computer-based. So you can do it through ERPs, okay, and MIS systems. So what will you do in the MIS system? So you will prepare the daily reports. Now in a daily report, you can have the daily cash report. So this much came, this much went out. So this is the today's position. So the actual cash flow, the budgeted cash flow, everything, it will be monitored on a daily basis. So you can generate daily cash reports based on that. Now these daily cash reports, they are best vehicles for running your comparison between the forecast and the actual cash flow. And this daily cash reporting is very useful if the cash budget and the forecast are not available on a daily basis. So on a daily basis, if you see that this is not available, which means that you immediately go for this correct action. It also helps you to understand how the cash is flowing on a daily basis, where it is going, and the comparison of the cumulative figures also, it indicates that the target is still to be achieved. Okay, whether you are going to achieve the target, so you know I have to go here, how far I am proceeding, and whether my target is being achieved or not. So the daily reports actually will help you to know whether you are achieving your target on time or you are falling short of the target. So you can reach many meaningful analysis can be done if you consolidate your cash positions on a daily basis. And there could be several formats of how you manage your MIS. It depends on varies from one organization to the other organization. So depending on the kind of business you have, you can design your ERP and your MIS in a way which will capture the various expenses on the MIS cash report. So you can have several factors, several things on this thing, like payment of salaries and wages, like overhead expenses, like your minimum cash balance, how much you want to keep it, various kinds of financial things that you can do. So various entries you can do on your MIS, and you can design it as per your requirement, so that you keep track of the daily cash flow in your organization. So if the manager takes care of these four aspects of cash planning, how to deal with the uncertainty, how what to do with the surplus thing, how to manage the internal fund transfer, and then how to look at monitor it on a close basis through the MIS. If he takes care of these four aspects, then probably the cash management will be very efficient in an organization. So we come to the end of this cash management session today. Thank you.